All right, let's dive into one of the wildest stories in the AI space right now, CoreWeave. Their latest earnings report dropped, and it created this huge puzzle for Wall Street. Because on one hand, you had this incredible, explosive growth, and on the other, well, the market got seriously spooked.
Okay, so let's set the scene. It's February 26, 2026. CoreWeave, which is a super important cloud provider for this whole AI revolution, steps up to report its earnings. And the numbers, they are absolutely stellar. Growth is just through the roof. And they've got this pipeline of future business that would make pretty much any CEO weep with joy. Everything's looking golden, right?
And then, bam, this happens. Despite all that fantastic news, the stock doesn't just dip, it absolutely craters. We're talking down over 18.5% in a single day. It was a brutal sell-off that left a whole lot of people just scratching their heads.
So yeah, what on earth happened? How does a company report historic growth and then watch its stock completely tank? Well, that is the big question we're going to unpack here. And to do that, we really have to look at both sides of the coin.
And really, this slide sums up the entire head-scratcher. You've got the good news on the left, a massive 110% jump in fourth quarter revenue. Just explosive. But then on the right, you've got the bad, a net loss of $452 million. So investors are looking at these two numbers side by side, trying to figure out if CoreWeave is a rocket ship or a sinking ship.
Okay, so to really understand the bull case, the reason some people are so incredibly optimistic, we have to start with the most important part of CoreWeave's story, and that is its absolutely incredible backlog of business.
I mean, just look at this number, $66.8 billion. Let that sink in for a second. And to be clear, this isn't some pie-in-the-sky forecast or a guess. This is the total value of future revenue that CoreWeave has already locked down in signed, non-cancelable contracts. It is guaranteed business.
And hey, don't just take my word for it. The CEO himself, Michael Intrader, he basically laid it all out on the earnings call. He put it plainly. They didn't just grow fast, they became the fastest cloud company in history to hit that $5 billion annual revenue mark. Historic stuff.
You know what's really interesting, though, is who is buying. This isn't just one whale of a customer propping them up. They're signing deals with a who's who of tech and AI. You've got the big hyperscalers, the cutting-edge AI labs like Midjourney and Runway, and even huge enterprise companies like Mercado Libre. This isn't just growth, it's deep, diversified demand.
And if you want to see what that historic growth we talked about looks like in chart form, well, here you go. Just look at that jump, from $1.9 billion in one fiscal year to over $5.1 billion the next. The revenue literally more than doubled in 12 months. That right there is the definition of hypergrowth.
Okay, so that all sounds amazing, right? But there's always a but. This kind of growth doesn't come for free, and the price tag is exactly what sent Wall Street running for the hills. So let's look at the numbers that caused that massive 18% drop.
So here's the snapshot that had investors sweating. Their earnings per share, or EPS, came in at a loss of 89 cents, which was a bigger loss than Wall Street was expecting. And that net loss of $452 million? Yeah, for the market, that's a huge flashing red light. But as big as that loss was, it wasn't even the number that truly dropped jaws. No, the real bombshell was their spending plan, what's known in the business as capital expenditure, or CapEx. It's basically all the money they're pouring into building physical stuff, like the data centers and servers that power the AI cloud. And here it is. In 2025, the company spent nearly $15 billion on this stuff, which is already a ton of money. But their plan for 2026? They're planning to spend somewhere between $30 and $35 billion. They are literally planning to more than double their already massive investment in a single year. It's just an insane amount of cash. And the crazy part is, they're not even trying to sugarcoat it. They're telling investors flat out in their own report, hey, get ready, we're about to spend an aggressive amount of money, and yeah, our profits are going to take a hit in the short term. They're owning it.
So, how do we square this circle? You've got this unbelievable $67 billion backlog on one side, and this terrifying $35 billion spending plan on the other. It seems like a contradiction, but it's not. This is where the whole puzzle comes together.
First, we need to be super clear on what this revenue backlog thing actually means. It's not a wish list. It's not a hopeful projection. Think of it as business that is already sold. Done deal. Contracts signed, sealed, and delivered for services they'll provide for years to come.
And this is the key to everything. That $35 billion spending plan, it's not a wild bet on maybe we'll get more customers down the road. No, it's what they have to spend to build out the infrastructure needed to actually deliver on the $66.8 billion of services they have already sold.
So here's their playbook, step by step. First, they go out and sign these massive long-term deals, creating that giant backlog. Then they can take those bulletproof contracts to the bank and say, look at all this guaranteed money, and they use it to get billions in financing. Step 3, they spend all that cash on building out what they need. And finally, step 4, they flip the switch, the service goes live, and that revenue from the initial contract starts rolling in.
So to put it another way, they are spending a colossal amount of money right now to build the capacity for revenue that is already guaranteed to arrive later. It's not the old, if you build it, they will come model. It's, they have already come, so now we have to build it and build it fast.
Which brings us to the $67 billion question. Is this strategy pure genius, or is it an incredibly risky gamble? Let's quickly sum up the two opposing viewpoints.
And it really is two sides of the exact same coin. The bulls, the optimists, they look at that $66.8 billion in pre-sold demand, and they see an untouchable market position. The bears, the pessimists, they look at a $30+ billion construction project for next year, and all they can think about is the immense risk. What if there are delays? What if costs spiral? They're looking at the same facts, just through a totally different lens.
So here's the bottom line. CoreWeave is making a very deliberate choice. They are sacrificing today's profits for what they hope will be total market dominance tomorrow. And the most fascinating part of all of this whole gigantic bet is basically being funded by their own customers' future commitments.
And that's the question I'll leave you with. Is this a brilliant, calculated strategy to cement themselves as a pillar of the AI world for the next decade? Or is this a high-wire act, a massive gamble that they can build faster and bigger than anyone ever has, where even a tiny misstep could be catastrophic? The market sold off because it saw the risk, but CoreWeave is betting the entire company on the reward. And I guess only time is going to tell who was right.